It is, it's just wild to think about. To build the most advanced futuristic AI brains on the planet, the world's biggest tech companies have suddenly found themselves, like, completely dependent on a 150-year-old technology,
Oh, yeah.
which is just boiling water with natural gas. We have this tendency to view the digital world as existing in some, ethereal cloud, totally disconnected from physical constraints. You ask an AI a complex question and the answer just appears on your screen.
Right, but the digital ether is incredibly resource intensive. I mean, that seamless user experience, it completely masks the heavy industrial machinery running in the background. The power grid right now is undergoing a structural stress test unlike anything witnessed since its initial electrification, and is driven entirely by the exponential load demands of these digital technologies.
Welcome to the deep dive. Today we are tearing into NRG Energy's Q1 2026 earnings report. We've got their official press release, the investor slide deck, and the actual full transcript from their latest earnings call.
Yeah, and on paper, if you just glance at the headlines, this looks like a pretty routine quarterly update where a company missed its earnings per share targets. You might honestly be tempted to just skim it and move on.
Exactly. But that would be a mistake. And that's our mission for this deep dive. We are going to uncover the much bigger narrative hiding within these documents. We are tracking how a massive legacy energy provider is quietly re-engineering its entire business model to fuel the AI and data center revolution,
while at the exact same time effectively hacking the power grid from inside consumers' own home.
All right, I promise you, by the end of this deep dive, you will understand the underlying mechanics of why the future of the internet fundamentally relies on the very physical reality of natural gas turbines and smart home thermostats. So, okay, let's unpack this, because before we get into the aggressive, forward-looking AI energy boom, we really need to ground ourselves in the reality of the Q1 numbers to understand why the market reaction might look, mixed.
Yeah, the immediate financial context is totally essential here. You have to look at the mechanics of the earnings miss versus the revenue beat to actually see the pressure points NRG was navigating this quarter.
So let's lay out the raw numbers. NRG missed its consensus earnings per share target. Analysts expected $1.78, but the actual came in at $1.48.
Right, a clear miss.
But then on the top line, they absolutely smashed revenue expectations. They posted $10.26 billion in actual revenue versus an expected $8.43 billion. That is a massive 19.5% year-over-year growth. Adjusted EBITDA was $1.08 billion, which is just a slight dip from the prior year.
Yeah.
So how do you reconcile a nearly 20% revenue surge with an EPS miss?
Well, you find the answer by looking at the geographic realities of their operations. I mean, the quarter was defined by a tale of two entirely different weather systems, which is basically the perfect illustration of the geographic and physical risks inherent in the merchant power business.
Right. Weather is everything.
Exactly. So down in Texas, operating within the ERCOT market, the weather was exceptionally mild. Like, heating degree days plummeted by 30% year over year.
Which completely guts retail load, right? And it flattens market volatility. In an energy-only market like ERCOT, which relies really heavily on scarcity pricing to generate outsized margins, boring weather basically means boring returns. I mean, Houston on-peak prices averaged a mere $29 per megawatt hour. That's down 13%.
Right. Meanwhile, the East Coast, specifically the PJM market, was experiencing the exact opposite scenario. They got hit hard by Winter Storm Fern in late January.
Oh, yeah.
And that physical strain on the grid caused massive price spikes. PJM West Hub on-peak prices averaged $103 per megawatt hour. That's up 72% year over year.
And this highlights the most agonizing part of the Q1 puzzle. We really have to talk about the deeply ironic timing of NRG's major acquisition of the LS Power assets.
Yeah.
So NRG bought this massive portfolio of generation assets from LS Power to specifically bolster their supply position on the East Coast, right?
Yeah.
But the ink on the deal officially dried, and it officially closed on January 30th.
Right after the worst of Winter Storm Fern had already passed?
Exactly. Think about the mechanics of being a retail energy provider during a winter storm without your own physical hedge. You are legally obligated to supply power to your retail customers at a fixed contracted rate. But if you don't yet own the power plants to generate that electricity yourself, you are forced to buy it on the open wholesale market exactly when prices spike to $103 per megawatt hour.
It's brutal.
It's like buying a top-of-the-line snowplow the day after the biggest blizzard of the decade. Like, you still had to pay exorbitant emergency rates to clear your lots during the storm, while your newly purchased plows were just sitting uselessly across town.
That is a great way to put it. And if we connect this to the bigger picture, the financial impact of that timing mismatch explains the EPS drag perfectly. But focusing solely on that short-term pain misses the structural advantage NRG just secured.
Because they have the assets now.
Right. Despite the Q1 timing, those newly acquired LS Power assets bring NRG's total capacity to roughly 25 gigawatts. I mean, they essentially doubled their fleet with modern, flexible natural gas assets.
Wow.
This is why management used the earnings call to adamantly reaffirm their full-year 2026 financial guidance. They basically view the storm impact as a sunk temporary cost, whereas the 25-gigawatt fleet is long-term leverage in a tightening market.
Which naturally leads us to how they are expanding that physical footprint even further. Because acquiring existing assets from LS Power is one thing, but NRG is also actively building new generation from scratch. And in the current regulatory and economic environment, developing new natural gas plants feels like a completely lost art. Very few companies are successfully breaking ground on these projects.
Yeah, the broader energy sector has largely pivoted away from heavy, dispatchable thermal generation over the last decade, focusing capital instead on renewables and storage. Developing massive gas facilities requires a specialized engineering capability and a real appetite for regulatory navigation that many firms just simply allowed to atrophy.
Yet NRG is leaning in hard. Let's look at their Texas Energy Fund, or TF, projects. They are bringing 1.5 gigawatts of new dispatchable natural gas generation online. Just to quantify that for you, 1.5 gigawatts is enough firm baseload to power roughly 300,000 Texas homes at peak summer demand.
It's a huge addition.
Yeah, we have the T.H. Wharton facility, a 415-megawatt plant, expected to come online in May 2026.
And the execution metrics on T.H. Wharton are particularly notable here. Coming in on time and on budget in today's supply chain environment is rare enough, but NRG's timeline also qualifies them for a $55 million TF completion bonus.
Oh, wow, $55 million just for finishing on time.
Exactly. Plus, they also have Cedar Bayou 5 and Greens Bayou 6 aggressively tracking for mid-2028 completions. The new CEO, Robert Gaudette, pointed out something crucial regarding these timelines on the call. NRG didn't just, wake up when the Texas Energy Fund was announced. They had acquired the sites, handled the preliminary permitting, and prepped the groundwork years in advance.
Okay, but let me push back on this strategy, though. We are sitting here in 2026. We have watched billions of dollars pour into utility-scale battery storage across ERCOT over the last few years. If you are NRG, why deploy such massive capital into heavy, slow-to-build natural gas assets? Shouldn't the sheer volume of battery storage hitting the grid be enough to solve the problems? Like, absorb those peak demand spikes, making new gas plants economically obsolete.
I mean, it is a logical assumption, totally. But Gaudette explicitly addressed the deteriorating economics of battery storage on this very call. The arbitrage margins for batteries in ERCOT are compressing rapidly right now. Yeah, batteries are highly effective at shifting the peak, taking the localized strain at 5 p.m. and discharging it at 9 p.m. However, they do not generate net new baseload power. They consume power from the grid to charge, suffering round-trip efficiency losses in the process.
Okay, so they eat the volatility, but they don't actually solve the absolute supply deficit.
Precisely. The grid is no longer just facing a curve smoothing issue during the evening ramp. It is facing a structural 24/7 tidal wave of absolute demand. When total system load outstrips total generation capacity across a multi-day weather event, or during continuous heavy industrial draw, a battery that discharges for 4 hours and then needs to recharge from an already strained grid is, well, it's a liability, not a solution. For absolute demand growth, you require firm, dispatchable, new baseload generation.
And that absolute demand growth is the 367 gigawatt elephant in the room. This brings us to the most staggering piece of data in the entire earnings report, driven almost entirely by the rapid expansion of AI data centers and broader electrification. Here's where it gets really interesting, and I want you to visualize the scale of this. The all-time record peak demand for the entire Texas grid, meaning every factory, every hospital, and every residential air conditioner running at maximum capacity on the hottest August afternoon in history, is just over 85 gigawatts.
Right, and that 85 gigawatt figure represents over a century of gradual industrial and population growth in Texas, aggregated into a single peak moment.
Exactly. Now look at the preliminary long-term load forecast recently filed in ERCOT. The pipeline of large load interconnection requests, the amount of power companies are actively petitioning to draw from the grid for massive new facilities, reaches over 367 gigawatts by 2033.
It's almost hard to comprehend.
It is. That is more than 4 times the current record peak, slated to hit the grid in under a decade. Try to conceptualize taking the entire historical power footprint of Texas and stacking 4 more identical Texases on top of it, purely to feed data centers and industrial electrification.
Well, what's fascinating here is that we have to apply a heavy discount rate to that 367 gigawatt figure, which Gaudette responsibly noted on the call. The interconnection queue is notorious for speculative phantom load. Companies will file multiple requests to hedge their geographic bets, fully knowing only a fraction will be built.
Right, it's like putting your name down on 5 different restaurant wait lists just to see which one clears first.
Exactly. However, the exact final number almost doesn't matter. If even 50 to 80 gigawatts of that pipeline materializes, it fundamentally rewrites the economics of the power market. It chews through any excess battery capacity.
Because an influx of 50 gigawatts of 24/7 data center load instantly consumes whatever excess reserve margin ERCOT currently holds. It guarantees that the system operates in a constant state of tightness.
And in an energy-only market, structural tightness equals relentless scarcity pricing. As reserve margin shrinks, wholesale prices elevate, and the intrinsic value of legacy, dispatchable thermal fleets, the exact assets NRG is acquiring and building skyrockets. They transition from being peaker plants that only run a few hours a week to the indispensable backbone of the digital economy.
And NRG clearly sees this bottleneck coming, and their capital allocation proves it. They aren't just relying on their current TEEF projects in Texas. Through their venture with GE Vernova and Kiewit, they have secured turbine manufacturing capacity and the EPC engineering, procurement, and construction resources for 5.4 gigawatts of new build opportunities.
Which is incredibly smart. Securing the EPC and the turbine queue right now is brilliant risk mitigation. As this massive load demand becomes undeniable to the rest of the market, every utility will rush to build, and the resulting bottleneck won't just be regulatory, it will be physical.
Because you can't just spawn a turbine out of thin air.
Right. There are only so many engineering firms capable of building these plants, and only a few facilities globally that forge the turbines. NRG is locking in the labor and the hardware years before the premium spikes.
And it's not strictly about pouring new concrete either. Over in the PJM market on the East Coast, they have identified up to 2 gigawatts of upgrade and conversion opportunities within their existing fleet. We are talking about taking simple cycle gas turbines and upgrading them to combined cycle units.
Sweating the existing assets is vastly superior to greenfield development when you factor in the regulatory hurdles. By upgrading simple cycle to combined cycle on an existing physical footprint, you often bypass the brutal PJM interconnection queue because you already hold the interconnection rights.
Right, you're basically grandfathered in.
Exactly. You are squeezing more megawatts out of the same geographic footprint, increasing thermal efficiency, and deploying capital much faster than a competitor trying to permit a brand new site.
Now, we've spent a lot of time analyzing the macro, grid, massive physical power plants, giant AI data centers, securing turbine supply chains. But the second half of NRG's strategy operates on a completely different scale. To fully understand this earnings report, we have to look at the microgrid. NRG is fundamentally altering the mechanics of the power market from inside your own home.
Yeah, the integration of their consumer-facing retail business with their generation fleet is what separates them from a pure-play, independent power producer. They are manipulating both sides of the supply and demand equation simultaneously.
Let's break down the consumer numbers. NRG's Vivint Smart Home division is absolutely thriving. They ended the quarter with 2.37 million customers. That reflects a 9% year-over-year increase. Combine that footprint with their recent acquisition of C-Power, which is a leading commercial demand response business, and you have the foundation of their virtual power plant, or VPP initiative.
And the VPP is arguably their highest margin defense against grid volatility.
So what does this all mean? What does a virtual power plant actually look like in practice for you? Imagine a critical grid event in Texas. It's 105 degrees, the wind dies down, and wholesale power prices hit the ERCOT market cap of $5,000 per megawatt hour. Historically, an energy retailer caught short in that moment would bleed capital buying at the cap to serve their customers.
Right, it's a nightmare scenario.
But now, through the VPP, NRG can instantly ping millions of Vivint smart thermostats across the state. They algorithmically dial back the air conditioning by a single degree. An adjustment so minor you barely even feel it in your living room.
But by aggregating that microscopic reduction in demand across millions of nodes, they instantaneously shed massive amounts of load. NRG's Texas residential VTP program just officially surpassed 200 megawatts of dispatchable load reduction, with a stated target of reaching 1 gigawatt by 2035.
Reaching a full gigawatt of demand reduction is basically the equivalent output of a massive nuclear reactor. But instead of spending a decade and $10 billion pouring concrete, NRG is creating a virtual power plant out of thin air, purely through communicating with the smart devices already mounted on your wall.
And the strategic brilliance of that software is staggering. Every megawatt of demand they shave off their retail obligation during a scarcity event is a megawatt they do not have to purchase at $5,000.
Wow.
It turns avoided costs directly into protected margin. Plus, they incentivize the homeowner for participating, which dramatically reduces customer churn in a highly competitive retail market. Nobody else in the industry possesses both the legacy retail electricity book and the proprietary smart home hardware ecosystem required to run this kind of closed-loop system at a multi-gigawatt scale.
It is genuinely wild to realize that the physical infrastructure required to let you generate an image with an AI model might be subsidized by your own hallway thermostat, quietly keeping the lights on. It's a complete convergence of digital load and physical grid management.
Yeah. And as we synthesize the entirety of this Q1 report, the overarching theme here is the rapid implementation of a new corporate philosophy. Robert Gaudette stepping in as CEO to replace Larry Coben marks a really distinct shift toward relentless operational discipline and rigorous capital allocation.
You see that discipline immediately in their balance sheet restructuring. They successfully closed a massive $3.5 billion refinancing initiative right after the quarter ended. Plus, they expect to repay $1 billion in debt this year, alongside the $817 million in share repurchases they already executed by the end of April.
They are fortifying the balance sheet to secure long-term contracted cash flows. They are deliberately moving away from the daily volatility of merchant power pricing, positioning themselves as the premier, heavily capitalized partner capable of supporting the AI boom and signing decade-long power purchase agreements with the world's largest hyperscalers.
Which leaves us with a provocative final thought for you to ponder. We usually reflexively point to companies like Google, Microsoft, or OpenAI as the undisputed primary drivers of the AI revolution, the entities that will control the future. But you cannot code your way out of the laws of thermodynamics.
No, you can't.
As these AI models grow exponentially more complex, they require an unimaginably massive continuous flow of raw, physical electricity. If access to firm power becomes the ultimate bottleneck for digital advancement, you have to ask yourself, will the ultimate tech monopolies of the 2030s actually turn out to be the legacy power and energy companies, the firms that physically own the turbines and control the actual plug?
It's a great question, because the smartest algorithmic brain ever created is entirely useless if the facility housing goes dark. Power really is the ultimate upstream constraint.
The invisible magic of the digital world relies entirely on the heavy iron of the physical one. Thank you for joining us on this deep dive.